If you have a parent or grandparent living with you, or you are thinking about bringing a senior family member into your home, there is a federal tax credit you should know about. It can put up to $7,250 back in your pocket, and it's refundable. That means you get the money even if you don't owe any tax. But there's a catch. Most Canadians who hear about this credit assume any home renovation qualifies. That's not how it works. Let's make retirement a little smarter. This credit is called the Multi-Generational Home Renovation Tax Credit, also known as the MHRTC. It was introduced in 2023 to help families create a separate living space for a senior, or an adult who is eligible for the disability tax credit. The idea is simple. If you create a self-contained secondary unit, so a qualifying senior or an adult eligible for the disability tax credit can live with a qualifying relative, this credit may help cover part of the cost. The maximum credit is $7,250, which is 14.5% of up to $50,000 in qualifying renovation expenses. Now here's the most important thing to understand. This credit is not for general home repairs. It is not for simply adding a bathroom by itself. It's not for replacing your roof, upgrading your kitchen, or installing grab bars on their own. Those things might qualify for other credits, but not this one. The MHRTC is specifically for creating what the CRA calls a self-contained secondary unit. That means a separate living space in your home or on the same property, with its own private entrance, kitchen, bathroom, and sleeping area. It needs to function as a complete and independent living space for the family member who's moving in. So, who actually qualifies? Two people need to be involved. First, the person moving into the secondary unit. The CRA calls them the qualifying individual. This must be a senior who is 65 or older by the end of the tax year, or an adult who is eligible for the disability tax credit. Second, the person claiming the credit. The CRA calls them the eligible individual. This is usually the person who paid for the renovation and meets the CRA's eligibility rules. In many cases, that person is the homeowner, a spouse or common law partner, or a qualifying family member. That includes parents, grandparents, children, grandchildren, brothers, sisters, aunts, uncles, nieces, and nephews. The unit must be created so that the senior or DTC-eligible adult can live with a qualifying relative. Both the qualifying person and the qualifying relative must live, or be expected to live, in the home. For the new secondary unit within 12 months after the renovation is completed. What kind of expenses qualify? Things like construction materials, contractor labor, building permits, professional services like electricians, plumbers, and architects, and equipment rentals needed for the renovation. What doesn't qualify? Your own labor, your own tools, furniture, appliances, regular maintenance, and any expenses already claimed under another credit, like the medical expense tax credit, or the home accessibility tax credit. You cannot double dip. Now here's a rule that surprises a lot of people. This credit is once in a lifetime per qualifying individual. That means if you claim it for your mother, you can never claim it again for her. If a different qualifying family member needs a separate qualifying renovation later, another claim may be possible. But the same qualifying person can only be used for one MHRTC claim in their lifetime. To claim the credit, you complete a tax form called Schedule 12 as part of your tax return, and report the amount on line 45,355. You'll need to keep all your receipts, invoices, and contracts for at least 6 years in case the CRA asks for proof. And here's one more thing to know. If a family member or related person does paid work on your renovation, be careful. Those expenses usually do not qualify unless that person is registered with CRA for GST or HST purposes and all other conditions are met. Remember, you claim the credit in the year the renovation is completed, not when it starts. Here's the bottom line. The MHRTC is a refundable federal tax credit worth up to $7,250. It's only for creating a self-contained secondary unit in your home, or on the same property for a senior 65 or older or an adult eligible for the disability tax credit. Maximum eligible expenses are $50,000, and the credit is 14.5% of that. You can only claim this once per qualifying individual in their lifetime. Keep all your receipts. File Schedule 12 with your tax return. For questions about this credit, call the CRA at 1-800-959-8281. If this video was helpful, please give it a thumbs up. It really helps more seniors find this information. Subscribe to Wise Senior Canada so you never miss an update, and if you have questions or comments, drop them below. See you in the next video.